All right, let's move into our last segment here today, guys. And obviously, on a Wednesday, every Wednesday, we have Coach Tyler join us. He's the head of the trading lab over at Tackle Trading. We call the Phoenix Trading Lab. He's a veteran trader, he's an options educator. He's written classes around it. He's taught thousands and thousands of students in the options market. And so we decided to give him a little segment every week where he gets to highlight some kind of option strategy or option segment. We call it Jedi Options. Tyler, what you got for us today?
Oh, cooking out some good stuff for you today. Let me kick it off with the statement: fool me once, shame on you. Fool me twice, shame on me. I feel like we're setting up potentially for that type of scenario with the market. And what I mean by that is many bulls could say, look, you got me over the last week or two. You were in an uptrend. You broke support. You broke the 50-day. You made a lower low. All right. Took a hit on my bull trades over the last 2 weeks. On Monday, let's say you were feeling a little bit skittish. All right. You a little too much pain. Maybe you were a little overexposed. Didn't think the market would sell off that much. So you were praying for a reprieve. I think the last 2 days you could qualify as the reprieve, right? I have bullish positions. I've made some money back over the last couple of days. You've gotten a reprieve. Now, my question to you is, suppose the Fed screws this up, they don't deliver, and we go down again. Suppose this is a bear retracement. Hope it isn't, but maybe it is. I would be taking assessment of my portfolio right now. I would assess my overall exposure, and I would say, look, this is a chance for me to lighten up, reduce exposure, tighten things up if I felt very uncomfortable on Monday, so that if this happens again, I'm not, in the hole in 3-4 days again, praying when the S&P is at 425, 420, please give me a bounce. You got your bounce. If it rolls over and you do nothing again, that's on you, okay? The fool me twice, shame on me thing. So let's say that's where your head's at and you're interested in reducing exposure here. You could take off bullish trades. You could lighten up, right? Take some off the table into the strength here. But the strategy that I want to illustrate today is maybe adding a little bit of bearish exposure to the portfolio, not aggressively, not with like buying puts or a put spread, but more conservatively with a cash flow type play, like a bear call spread. So I think the technical setup could lend itself to, now I don't know if we're going to roll over, right? We're playing chess here and we're thinking multiple moves ahead. We're anticipating all potential scenarios. I could see the market rolling over here. Hope it doesn't. But if it does, I want to have something ready to go that I can throw on. And I mapped out what I think is an interesting bear call spread idea. So I want to spend maybe a couple of minutes explaining the bull. Did I say bull call? If I did, I meant bear.
You said bear call.
I did. Okay.
Yeah,
I'm going to explain the bear call, and then we'll build one on not an individual stock. When I try to hedge a portfolio or just reduce exposure, the most direct way to do that is to use an index or an ETF. So we're going to build one on SPY. All right. So in terms of what a bear call spread does, I'll give you a little breakdown here. Bear call spread goes by a couple different names. It's also known as a short call vertical spread, or you're selling a call vertical credit spread if you really want to be redundant, okay? The idea here is you're going to sell out of the money call options that you expect to expire worthless. You expect these will expire worthless, but instead of selling naked calls where you have open-ended risk, you're going to cover that by buying a further out of the money call, which creates a call spread. So the structure is you're essentially going to sell an out of the money call and buy a further out of the money call. And we're going to usually use short-term options to narrow the window in which the trade can go against us, as well as take advantage of the higher rate of time decay, right? So when I look at the S&P, I say, where am I willing to bet we're not going to go above? Where am I willing to sell calls that I think aren't going to, end up moving in the money? And the prior high, indeed the all-time high of the market thus far, was 454. So I'm thinking, okay, if we roll over, obviously, we're not getting up to 454, but just in case we don't, or we just chop around a little bit, I'd also like to set up a cash flow play where I still win as long as the S&P doesn't make a new high, say over the next 3 to 4 weeks, right? So that's kind of the type of bet that I'm trying to make. And this is going to help obviously make it a little less bad if the market rolls over. This will be one position that will give me money as maybe I'm taking a hit on some other bullish trades. Okay, so I'm going to come into the trade tab, and initially I'm like, is 23 days going to be enough time? Usually we like to sell these 30 to 45 days out. So I initially was looking at a 30-day weekly option. But sometimes, you want to use process of elimination when you're building the trades, but try something. And if it doesn't work, then go to a different day. So I actually think we can make this work with 23 days out. And so I'm anchoring on the 454 as kind of that prior pivot high as my level. And I want to see if I can sell a call right around there and then maybe build a $5 wide spread. So I'm going to sell the 454. All right. And then I'm going to buy a 459. And right now you're getting about 51 cents for that. Now, rule of thumb, and there are different guidelines depending on how aggressive you want to go. But for me, when I do a really high probability credit spread, I want at least a 10% return, which usually corresponds with 10% of the spread width. So the spread width here is 5, 10% of that is 50 cents, which fits the bill, right? And when you look at the delta of this call option at 13, that tells me the probability that that's going to be out of the money is 87%. So I have almost a 90% probability of profit. And that profit is about a 10% return. So 90-10, like 90% chance of making about a 10% return. I'm satisfied with that when I'm doing a credit spread, right? And so when I right click and analyze this and look at the risk graph, this is what she looks like. Right, so this is the risk graph of a bear call vertical spread. You can see if you look at the blue line, that's max gain versus max loss at expiration. Anything below 454, look at the blue number down here, I'm making 51 bucks, right? Now, there's quite a bit of asymmetry when you do a high probability trade. In theory, you're risking a lot to make a little, which is the nature of having a 90% chance of making money. They're not going to give you a 100% return with those types of odds. So because of that, you might say, man, I'm pretty uncomfortable with all that potential risk. Well, all you've got to do is have a plan, have an exit strategy. And the reality is two things here. Number one, my portfolio is bullish. I would be tickled pink if I'm wrong with this bear call spread. I'd be tickled pink if the S&P rips to a new high over the next 3 weeks, because that means I'm going to make quite a bit of money on all my existing positions. So you have to remember, when you add a hedge to a portfolio, when you add a bear trade to an existing bullish portfolio, what do you really want to happen? Sure, I'd like to win on both. I'd like to win on the bear trade and the bull trades. But if I had to pick, sure, punch me in the face on the bear call, because I got a lot more bullish exposure, right? So that's one thing to keep in mind, is what role does this bear call play in the overall portfolio? But secondly, you don't have to take the max loss. The reality is, if the S&P breaks above resistance here and pushes to a new high, I probably want to get out of the thing. And so if I take a look, if I bail around 454, risking about 175 bucks, about 3 winners. Often with credit spreads, you're risking 2 to 3 winners to make 1. And that is the nature of, having a 90% probability of winning. Your average loss will be larger than your average gain. I'm fine with that. That's the nature of this type of trade. Okay. So 175 though is still better than the max loss, which is 450. Okay. So I would not eat max loss if we rip higher. The final comment I'll say in terms of the trigger is you have to decide, when do you pull the trigger? Do you want to anticipate that this bounce is going to fail and throw that bear call spread in now in front of the Fed meeting just in case? Do you want to wait until we see some evidence that the intraday chart is rolling over? Right now, it doesn't look that bad. Maybe you wait for us to take out some support zones before you add that bear call. Either way, your call, but I just like this idea of index break support, bounces back, think it could be a bear retracement, easy way of adding some positive theta to the portfolio, as well as negative delta, just to hedge a little bit. Throw me an out of the money bear call above resistance. I think it's a decent idea in this type of environment.